To say today's environment is challenging would certainly be an understatement. The choice we get to make is, are we going to be paralyzed by the puzzle or propelled by the path? So after that intro, Matt and I were talking a lot about alliteration. Forgive me, a whole lot of P's are coming your way. Most notably, our four pillars of this commentary: the participants, the path, the problem, and the puzzle. So who are these actors in this drama, and what are they about for purposes of this commentary? Number one is investors. Investors, as I want you to think about right now, tend to be defined by very binary mindsets. They view things as either good and getting better or bad and getting worse. Advisors, being the second one, or just the investment industry as a whole, they tend to be defined by just static approaches, being perma in their approach, spouting cliches like stay invested, earn it for the long term. And while there's truth to that, the reality is courses need to change over time. Again, not out of fear, not out of greed, but hopefully actually the inverse. Lastly is markets. They're anything but like investors or the market or the investment industry, in the sense that they're there to surprise people all the time. They can't be easily defined as good or bad, and they're ever moving, ever changing. With that, so what is the path? What is this journey, and why even take this journey? Because there's going to be the pain of volatility along the way. Well, the biggest reason you need to take that journey for most people who aren't crazy wealthy is to reach certain goals and dreams you have. This could be something very exciting. It could simply be making sure you can take care of your family through retirement. And that comes with three realities that I really need you to not only keep in mind, but really make true for you. Number one is you need to leave the shore. Sitting down, I know it can be scary. I know there's weather out there, but you need to leave the shore. And the biggest reason is, even in a less than hyperinflationary environment, think about the classic 3%, over a 10-year time frame, that's going to erode over 25% of your purchasing power. You put that together over a couple decades of retirement or leading into retirement, just sitting in cash, sitting on the shore, you're simply not going to be able to afford to live, let alone make a lot of your dreams come true. Second then is embracing that, yes, there is going to be volatility. That is the price you pay as an investor to be able to get across the proverbial ocean to the other side. The good news, again, as we've talked about before, success is not predicated on being able to predict the market weather. Get a sound ship, get a great allocation, have a captain who's navigated those seas before, and who, again, unlike those in the investment industry we alluded to above, understands the need to tact and change course to help safely get you across the seas. The problem, point number three, is that, again, investors, because they're binary, good or bad, they want to predict. For the advisors, they're more interested in pushing products or having an easy go of it than they are really embracing being students of the game, and then having the courage to act, to go out there, to do things, as we'll allude to here in a minute, like sell your fixed income, at least in part a couple years ago, to, again, navigate risk. They're more static in their approach. Here at 10, as we'll allude to with using bonds as an example, we understand that the path to success is going to take a lot of different directions, and that we're going to need to be able to tact. It's why we encouraged and raised cash within our strategies in a lot of cases in January. It's why, as we'll allude to here, we've had a lot of differing advice on fixed income, generally speaking, here over the last few years. So for the puzzle, what to make of this current environment? For most of people, they feel trapped between a rock and a hard place. On the one hand, you have inflation walking you down, eroding all of your hard work and your savings. On the other hand, the stock market seems very scary right now. We're going to put that aside for a moment and just talk about, is there anything that can be done? And this is where, after some time off, we really think fixed income can play a role for a lot of different investors out there, because, again, the market isn't just good or bad. We're in this stagflation type environment, moderating economy, Fed beginning to cool, and at the same time, supply chains are easing. There's some positive data out there within the corporate earnings and other places. And so we might be in a meandering path, point number one, but bonds at least will get you paid something. Secondly, if we do enter into a more severe recession, bonds are likely to resume their risk-off powers once again, to not only at least protect, but maybe even help you profit. And third, if the Fed, and when, as they will, eventually eases and rates come down, you'll see that. Now, a lot of you are like, well, isn't there a fourth path that the Jackson Hole meetings alluded to, which is the Fed is just going to keep raising rates, and isn't that going to erode a lot of purchasing power? This is where you have to understand, again, how much of that is already priced in. And in that case, we believe most of it is, maybe even more than will actually play out. So again, that could be a tailwind to a lot of different types of fixed income over time. So our history on bonds is part of this puzzle and not being perma and pulling these things together of kind of the classic issues, the current environment, and how we hope to help people here at 10 Capital. One, if you go back to November of 16, Trump's just been elected. For some of you, forgive me for the lack of a trigger warning, but bonds are getting smacked. Tons of scary headlines around get out, it's going to be a reflationary environment. Bonds are going to get smoked. And we came to you in a piece called Lions and Tigers and Bonds, oh my, on November 18th and told you, no, stay the course. Do not give up on your fixed income at this time. They were there for us in 2018 during the midst of that crash. But from that point until our next warning, the Barclays Aggregate Bond Index went up almost 22%, which brings us to August 7th of 2020, where we told you the classic 60-40 is dead for the time being. You need to relook at your static allocations. And the piece was called How to Invest in a Post-60-40 Era. Since that piece to today, the ag is down over 12.5%, which brings us, again, pulling this together to today's piece, Paralyzed by the Puzzle, Propelled by the Path. We just encourage a lot of investors to take a fresh look at fixed income. A lot of conservative in terms of their credit quality, paper out there paying over a 4%, some cases tax-free, that we really think, again, could be the solution for a lot of this environment for investors moving forward. In summary, don't be perma anything. You got to keep an open mind, you got to keep cool, and you got to keep a lookout for opportunities. The challenge with that last one, or maybe in all three, is those opportunities often look like the things that have been a recent disappointment. But that, again, is the counterintuitive truth and path to success as an investor. Thanks so much.